Now we move on to the next part, which is managing your risk. Like most people, once I had a market entry strategy in place, once I was able to understand what stock to buy, what price to buy it at, and what price to get out at, and I had an objective decision-making process, I realized that I still wasn't making the kind of money, consistent returns from the market as I had anticipated. Which is when I realized that without a risk management system, I was losing more money than I was making. In hedge fund vernacular, we call it eating like a bird and shitting like an elephant. A little extreme, I know, but you get my point. And it was not until I was able to put together a comprehensive risk management system that I was able to make my system work, my trading system work. And it wasn't until then that I was able to get consistent returns from my investments. Now, the risk management system that we will create will work with your market entry strategy and will be linked to the size of your capital. It will make sure that you have a good risk to reward ratio. The amount of money you stand to make for every rupee that you risk. That's your risk to reward ratio. Now, in order for your trading system to work, either you should have a high risk reward ratio or a high success ratio. And in doing this and in creating this risk management system, you will understand which one you have so that you can accordingly work with that. You see, if you have ever put on a trade, you will know that for most novice investors, every trade that they put on and every investment that they make, there is only one way the price can go up, right? Now, as a rational human being, for someone who's not in that trade, you know that's clearly not the case. Any trade can be loss-making or profit-making. But when you are a novice, when you're a beginner, you're getting into your trade, the trade that you've taken, there is only one way that the price will go. So if we know that there will be losses, we have to work with that. Our trading system, our trading plan, and our business of trading has to be geared for that, has to make sure that the losses are part of the process. And in order to do that, we have to make sure that our risk to reward ratio is constantly monitored. So what is the risk reward ratio? The risk to reward ratio measures the amount of profit that you are likely to make for every rupee of risk that you take. It works something like this. Let's say you decide to buy HDFC Bank. Now, let's say that HDFC Bank is trading at 1,000 rupees. So that becomes your entry price. You decide to get in at the price of 1,000 rupees. That's your entry price E, right? Now, let's say that your risk reward, your market timing strategy says that you will get out when the price reaches 980 rupees. That's a loss of 20 rupees per unit. Accordingly, you also decide that you will book your profits when the price moves up 60 rupees. So at 60 rupees, you will book your profit, or at 1,060 rupees, you will book your profit. That is a profit of 60 rupees versus a loss of 20 rupees. Now, we know as rational human beings, as people who are not in the trade, that either of these situations can happen. The risk to reward ratio is calculated by dividing the amount of profit, potential profit, 60 rupees in this case, by the amount of potential risk, 20 rupees in this case. So 60 divided by 20 gives you a ratio of 3:1. Now, risk to reward ratio is called risk to reward ratio, but essentially when we calculate, it is reward to risk ratio. So reward comes before, risk comes after. So 3:1 is the typical way of saying it. A 3:1 risk reward ratio means that you will stand to make 3 rupees for every 1 rupee that you risk. Now, this is essential. If you couple this risk reward ratio with your success ratio, you will understand how risk management works. For example, let's say that your strategy is pure chance. Let's say it is a toss of a coin. And we all know that the probability of success in the toss of a coin is, well, 50%. So you can have 50% heads or tails either way, right? And that's what we call chance. Now, let's say your strategy is nothing but chance at 50%. Now, at 50% success ratio, if you take, let's say, 4 trades, 2 of them will go right, 2 of them will go wrong. So at 3:1 success ratio, let's see how much money you make. Let's say the first trade is a losing trade. You land up losing 20 rupees. You take the second trade. The second trade is also a losing trade. What's the amount that you lose? Again, 20 rupees. Your loss at the moment is 40 rupees. The next trade is a winning trade and you make 60 rupees. Now you suddenly making a profit of 20 rupees. The fourth trade that you take is also a winning trade and you land up making another 60 rupees. So that's 60 plus 20, 80 rupees is your profit. So even at 50% success ratio, which is, as I said, chance, luck, you're still making money if your risk reward ratio is in place. But this is still not the entire picture. We move on then to position sizing. Now, the industry maximum for a per trade risk is 2%. But on an average, we apply about 1% of our capital as risk for every trade. Now, this is how it works. Let's say you have a capital of 1 lakh rupees. At 1%, your risk is 1,000 rupees per trade. That is the amount of risk you will take per trade. So how do we apply our allotted risk to our trades? By controlling the position size, of course. Which means if we apply this to the earlier HDFC example, for a trade of 20 rupees risk, you will land up taking a position size of 1000 divided by 20 rupees, which gives us 50 units. Which means that if I take a position of 50 units, if the trade goes against me and I get out at 980 rupees, I will lose exactly 1000 rupees. Consequently, if it moves in my favor and I get out at 1060 rupees, I will make the same amount of money. 3:1 success ratio, or 3000 rupees. 60 rupees of profit multiplied by 50 unit size. So 50 into 60 is 3000 rupees. So every profitable trade, I will make 3000 rupees. And for every losing trade, I will lose 1000 rupees. Now, this is in stark contrast to a lay investor, how probably you have been trading all this while. For a lay investor, for someone who doesn't understand risk management, every trade that I will take is a sure shot, right? So I will put all my capital into that. So 1 lakh divided by the amount, the cost of that trade. 1 lakh divided by 1000 rupees. You see, the average investor is not looking at risk management as I've just shown it to you. The average investor thinks that this is a sure shot. And if you're shaking your head, you're absolutely right. It never is. But as an investor, as someone who's in that trade, it makes absolute sense. Because for them, it is emotional attachment. And as soon as emotions come in, rationale goes out. So for him, what he has done is he takes that 1 lakh rupees and buys all the stock possible. 1 lakh divided by 1000 gives you 100 shares. Now this is again a contrast to what we just saw. 20 units versus 100 units. His risk has already gone up 5 times. Now assuming that he puts in a stop loss, his risk is limited to 5 times. But in most cases, people don't do that. And this means the risk goes completely out of control. But in the situation that we looked at, his risk has suddenly increased to 5%. But it gets even worse. Now, let's say the price of HDFC is not 1000, it's actually 100. Now, suddenly, from 1 lakh divided by 1000 or 100 units, he's moved to 1 lakh divided by 100 rupees to 1000 units. Suddenly, the risk is completely out of place. He will have such a big drawdown on his capital account, on his trading account, that emotionally, he will be so charged, he will be so negatively charged that executing his strategy becomes impossible. And just by moving from 1,000 units, from 100 units to 1,000 units, he has increased his risk amount. Now, I promised you the holy grail of investing. This is it. As a core part of your investment plan, you will manage your risk not by the size of your capital, but by the size of your risk amount and the risk per trade risk that you will take. This is how it will work. Let's assume you have a capital of 1 lakh rupees. The per trade risk amount is 1% of 1 lakh rupees or 1,000 rupees. Now, let's assume, like in the HDFC example, your risk for that trade is 20 rupees. Then your unit size becomes 50 units, which means if you have a favorable risk reward ratio like we saw in the earlier example of 3:1, you will land up making 3,000 rupees for every 1,000 rupees that you risk. Understand the implication of this. You are no longer worried about the price of the underlying asset. You are more worried of what your risk amount is. And based on the risk amount, you are taking your position size. So your risk is always controlled. Your per rupees risk is always controlled. By controlling that, you are putting the probability of success in your favor, irrespective of whether the success ratio of your trading strategy is chance or better than chance. It's 50%, 60%, 70%. I haven't seen many strategies that go above 75%. But it doesn't matter, because if you understand risk management, if you understand position sizing, you can make any strategy work. So let's say you land up taking 12 trades with a success ratio of 50%. It means you will have 6 winners and 6 losers. When you take 6 winners, you will have 6 into 3 or 18,000 rupees as your profit. Subtract from that the losing trades. 6 losing trades will give you 6,000 rupees of losses. 18,000 minus 6,000 of loss gives you 12,000 rupees of profit, or 12% return on your capital. Now, it might not sound that great, but imagine doing this on a per month basis. Imagine you take 12 trades in a month. That's 12% every month with a 50% success ratio. That's really, as I said, the holy grail of investing. It doesn't matter, therefore, how good your investment strategy is, what the success ratio of investment strategy is. The combination of the two, the risk-reward ratio and the success ratio, that is what determines the profitability of your strategy. And most importantly, this system will allow you to repeat your returns on a regular basis. As long as you're implementing your strategy flawlessly, you will continue to see the results on a regular basis. Not a one-off as you might have seen in the past. But the key word here is flawlessly. Executing your strategy flawlessly, which is where your emotions come in. And believe me, if you don't conquer your emotions, if you don't develop the mindset of a trader, of an investor, you will not be able to execute your strategies. So let's go and understand how emotions work in the trading environment and how to conquer your emotions so that you're able to execute with without a problem. A study by the University of Cambridge shows how, as human beings, we are absolutely irrational when it comes to money decisions or decisions regarding money. The university conducted an experiment, and in this experiment, what they did was they got a bunch of volunteers and they auctioned a $10 note or £10 note. Now, obviously, as a rational person, you would say that the maximum anyone would bid for a £10 note is, well, £10 because that's the value of the note. But that's different from the price. There is a difference between value and price. Would you believe that in that experiment, that £10 note was sold for over £19, £19.65 if I remember exactly. And I've seen this happen many times. I've taken this same experiment and I've, as a game, played it with my students in live classes. And what I've seen is that same 500 rupee note that I put for auction in the class, it goes for as high as 1,000, 2,000 or even 5,000 rupees. It's irrational, but that's really where our emotions come in. And the findings of this experiment are crystal clear. It illustrates how, as human beings, we are irrational. We are emotion-led when it comes to money-making decisions or decisions regarding money. And if you've ever tried to stick to your budget, you will know what I'm talking about. Which is why, of course, in our financial planning course, we help you put together a foolproof system. And the foolproofing, by the way, is against you. With that system, you are able to deploy a budget or manage your budget absolutely without a problem. And if you want to know more about that, go ahead and check out our course on financial management. So when it comes to investing, why should we expect anything else? You are bound to make the same emotional-led mistakes, the same irrational mistakes that we make when it comes to other parts of our life. Right? So why would trading be different? Why would investment be different? To develop the mindset of a trader, to develop the professional trader's mindset, you have to see your strategy work over and over again. And I will help you develop this mindset of a professional investor. I will go more into details in the Conquering Your Emotions section. But for now, understand that without developing the professional mindset, market timing and risk management are absolutely useless. So that's really something to look forward to. And finally, the investment plan. So the 4 parts of the investment plan, the 4th part is, well, the investment plan itself. Now, as Benjamin Franklin once said, if you fail to plan, you plan to fail. Now, in this business plan of your investing business, you will take care of each and every aspect. How much capital you will have, what markets you will trade in, what time you will trade in, when will you decide to quit, when will you decide to make it bigger. All and each and every aspect is covered in the investment plan. I would go as far as to say you will also decide when your risk has gone too much, your losses have gone too much, and when you will actually stop trading or stop investing. Now, you will have an overall business plan, an overall investment plan, which specifies the criteria, which specifies every aspect of your investment business, and you will have an individual trade plan. Each trade that you are going to take will be chalked out and planned beforehand before executing, so that there are no surprises, no off-the-cuff, irrational decision-making, no objective decision-making, no emotion-led mistakes. Everything is looked at, everything is designed, everything is planned. You will learn how to trust your system. These are the 4 aspects of trade planning, and I will go into each one of them in a subsequent section. So I'll see you there.